Hello, everybody. I'm John. This is Strategic Investing, and today we are talking about valuation in regards to Xtract One Technologies. Is it undervalued, overvalued? And when they start making, more money, increasing their revenue, 30, 40, 60 million dollars in revenue, how is that going to affect the stock price? What are we talking about when it comes to a price to sales, a price to earnings, things like that? And so, first, what I want to do is compare Xtract One's current valuation to the current valuation of probably the most comparable publicly traded company that we have numbers available for, which is Evolve. We'll kind of do this comparison, and then we'll get into, okay, when Xtract One is making 40 million, 50 million, 100 million maybe in revenue, what is that going to do to the stock price with the context that we're going to go over here? So first of all, let's kind of walk through this comparison. Now keep in mind, Xtract One's numbers here for revenue and market cap, things like that, share price are in Canadian dollars, whereas Evolve's here are in US dollars. Now that doesn't necessarily make a difference for valuation, because as long as you're comparing the Canadian dollar market cap to the Canadian dollar revenue, that valuation is going to be done in the same way as comparing the US dollar revenue versus the US dollar market cap, and so on for Evolve. So valuation wise, we can do this comparison, but if you're just looking purely revenue versus revenue, then you have to keep in mind that conversion rate there. So just wanted to let you guys know that in case anybody's looking at this that way. Now, from price to sales, these companies are pretty comparably valued right now, 10.8, 10.2. Almost the same. If anything, you could say Xtract One has a little bit pricier of a valuation, but right about the same. Now, one thing I do want to say is whenever we're looking at this, we want to look at this as a comprehensive valuation as a whole. We can't just use one metric like price to sales. And even within price to sales, you want to kind of break that down further, because this is using the trailing 12 months, as I have it now, the trailing 12 months earnings, or in this case, actually, the trailing 12 months sales, which is revenue. So if you take essentially this price to sales, what it's doing is it's taking the trailing 12 months revenue, which in Xtract One's case, again, in Canadian dollars, is about 16 million. If you divide the market cap of 174 million by that 16 million, you get that number 10.8. Same thing here for Evolve. You divide the market cap by the trailing 12 months revenue. That's where you get the 10.2, right? So that gives us a picture based on the last 4 quarters. But what about the next 4 quarters? Because this is important, because what are they expected to do in revenue? So let's look at the analyst expectations for revenue for each of these companies. Now, if we look at Evolve, the average estimate, and again, each of these companies' fiscal years is lined up slightly different, but if we just look at their current fiscal year estimates and next year fiscal year estimates. If we look at the current year, 2025, average estimate is about 133 million when they finish out this fiscal year for revenue. Now, the next year, fiscal 2026, their revenue expectations are about 157 million, okay? That's only about 18% growth. Now, sure, 18% growth is decent growth. I'm not, knocking that necessarily. But in comparison to Xtract One, the average estimate here for the current year, fiscal 2025, is about 15 million, whereas the expectation for the next fiscal year is essentially double that, of about 30 million. So you're looking at expectations for basically 100% revenue growth, a doubling, versus only about 18 or 20% with Evolve. In other words, Xtract One is expected to grow 5 times faster when it comes to revenue than Evolve is. Now, you can say, which is definitely true, that Xtract One is, those estimates are probably with less confidence, let's say, than Evolve's, because Evolve already has a large base of revenue that they're growing from. A large part of that is subscription, and so it's much more predictable. Those analysts can make those estimates with much more confidence than, let's say, the ones that are making this for Xtract One. That is definitely the case, and that's a valid argument. And so from an investment perspective, you could say, yes, there is more risk associated with trusting those analyst expectations for Xtract One than there is for Evolve. But it definitely does seem that Xtract One has a much bigger opportunity for revenue growth than Evolve does. And that for one is just a function that they're growing from a smaller base. So while the price to sales for Xtract One and Evolve are roughly the same based on a trailing 4 quarters, the estimates for the next 4 quarters, or in other words, the forward price to sales, is much more favorable to Xtract One than Evolve. Now, the other thing that I think is really, really important when you're doing this comparison is the gross margin. You can see that Xtract One has a significantly better gross margin than Evolve does. Xtract One sitting at about a 64%, Evolve sitting at about a 56%. Now, some of you might be saying that's really not that big of a difference, but it is a huge difference here. If Evolve currently had the same gross margins that Xtract One had, if we change this to 64% here, that increases their gross profit by $10 million there. In other words, they would have actually been cash flow positive by a pretty decent amount in the last quarter, and possibly even, I'd have to look at it, but some of the quarters before. So that is a huge difference there, especially when you get into those larger revenue numbers. A few percent in gross margin can make a big difference. And the other thing to take into account here is Xtract One's gross margin really is actually much better than that, because this trailing 12 months gross margin is significantly brought down by the very last quarter here. You can see in the prior 4 quarters, which is these quarters here, the gross margin was 65, 64, and actually ticked up to 70%, and then dropped off significantly to 57. That drop is really mainly only a function of the ramp in the One Gateway, their new product. Whenever you start ramping production of a new product, the first initial products are going to be much more hands-on, less automated, and more expensive to build until you start to get the tooling really dialed in and you start to increase that production and build economies of scale. You know, the more and more you produce, the less and less each one costs. And so this is going to definitely tick up once they fully ramp the production there. And you can actually see it get much more closer to that 70% and even potentially more, because the One Gateway is likely going to have a better margin than the Smart Gateway does. So this is really a huge advantage for Xtract One when it comes to the valuation, because they are going to be able to be cash flow positive and profitable at a much lower revenue than Evolve is. And that's going to give them a huge advantage as they grow, not only just as a business, but also from a valuation perspective in the stock market, because they're going to be able to achieve a much higher market cap with less revenue, because it will be contributing more to cash flow and more to earnings than Evolve's revenue is. So that's what I'll say in comparison to the valuation there. I think from a trailing, basically, the summary there, from a trailing perspective, the last 4 quarters, the valuation is relatively the same for each and kind of makes sense. But from a forward, from an expectations of, say, the next year or even the year after that, Xtract One is looking much cheaper here, although understandably there is also more risk because it's a less predictable estimate than Evolve's is, right? So let's talk about then what we could see potentially as a valuation going forward with Xtract One if they're able to achieve certain revenue benchmarks, right? So we know that the gross margin should stay roughly around 65%. I would say, again, I think it could tick up higher, but let's just use the 65% on average for now. If we say in the next year here, let's say fiscal 2026, they are able to do that $30 million that we have in the estimates here. Sorry, that's 300 million. 30 million there. And we have a 65% gross profit margin. That gives us 19.5 million in gross profit. We know that they've said operating expenses are expected to grow only single digits year over year. So I put the highest being the most conservative here. Technically not even single digits. I just went to 10%. We're probably looking more like 6 or 7%, but just to be conservative here, 10% OPEX growth, that gives us operating expenses of somewhere around 23 million, depending on what they do in Q4 here. And then that would give us a loss of $2.7 million for the year. Obviously, you're going to get, no earnings from that, so you can't have a price to earnings. But from a price to sales, you can play around with that. I think where it gets really interesting is once we get into the 40 and $50 million revenue range. But before I show you that, one thing that I do want to mention, even with this loss, I think there's a 90% plus chance that if they are able to do this $30 million revenue, or even close to that for fiscal 2026, that fiscal 2026 is going to be a cash flow positive year for a couple of reasons. One, a large part of their cost of revenue, or a decent part of their cost of revenue, is depreciation, which is not a cash expense. And so even though we have technically a loss of 2.7 million, that depreciation counts in cost of revenue and counts against your technical profit, although it doesn't count against your operating cash flow. Similarly, we have stock-based compensation and more depreciation and amortization within operating expenses. And all of those together could make up, roughly 4 million potentially, or even more, of the total expenses that would be accounted for on the income statement for fiscal 2026. This means that even though technically you have a profit or a loss of 2.7 million in fiscal 2026, assuming all of these metrics are correct, you would actually have operating cash flow of potentially a couple $1,000,000 here in fiscal 2026, even with this loss. And I'll talk a little bit about, because I think I haven't talked enough about cash flow with Xtract One, I am going to do another video shortly after this one, so check out that one if you want a little bit more analysis on the cash flow and how that all breaks down. Now let's switch though really quickly to finish off this video and take a look at where the valuation might go if profitability increases, going forward from fiscal 2026, when we start to be probably consistently profitable on an annual basis. And this is where it gets really interesting. So let's say 2027, just to be really, I think, conservative here, let's say growth slows down from 100% down to 50%, and we only get, or like 65%. Say we only get to 50 million by 2027, 65% gross profit, 10% OPEX. We're looking at a profit at about $5 million. And again, I'm using, just so you guys know, about a 25% tax rate. Might be a little different than that, but let's just say that's roughly accurate. That would be a profit of around $5 million. And I think, I would say this 100 PE is definitely reasonable, considering that gives us also a price to sales of around 11, which is where they're currently trading right now. That would give us a valuation of about 500 million Canadian, or in other words, a US stock price of $1.60, a Canadian stock price of $2.22. I think that's conservative, not only from a revenue perspective, but from a valuation perspective. I think you could very easily justify a $200 or a 200 PE ratio. And some of you guys might be saying there's no way. And you look at that and you say it gives us a price to sales of 21. That's way too high. Here's the thing though, is at this inflection point here, where we start to get profitable, the revenue growth equates to an outsized move in profitability. So you look here, we have 50 million in revenue and we have 5 million in profit based on these numbers, right? But watch what happens if we just increase revenue. Say we go out one more year and we increase revenue by 50%. We get $15 million in profit. So what just happened there, right? Revenue increased by 50%, but profit tripled, right? So when you get to that inflection point, when we start to become profitable, as long as operating expenses continue to be managed well the way that they have been, we reach a point where that revenue is starting to quickly outpace the operating expenses, and the operating expenses are becoming a much smaller part when they were a larger part of the overall expenses. And so that's why I think you could justify that 200 PE and even that, 28, 21 price to sales, right? And so if I could, just kind of sum this up, I think from a current valuation standpoint, on a forward-looking basis, Xtract One is definitely undervalued in comparison to Evolve. But also, once you take into account what that potential for revenue growth does for the company combined with that better gross margin, you get an opportunity that is far better for Xtract One investors than Evolve investors. Again, assuming they're able to execute. So you do have, as an investor in Xtract One, a slightly higher risk based on just the point that the company's at in comparison to the base of revenue and whatnot that Evolve has, but you have a much larger opportunity. And if you combine that with the analysis of the technology and who has better tech and all of that, I think we're sitting with a pretty great opportunity here for Xtract One, and the valuation, as long as they're able to execute, should explode over the next couple of years here. So that's my thoughts. Again, it's just my opinion. It's not financial advice. You guys might have other ideas. Definitely let me know in the comments below what you think of my analysis. If you think I missed anything, I always like to go through and kind of compare my notes. So definitely do that. Let me know in the comments below. Other than that, I hope this helped you guys out. Hope you guys have a great rest of your day, and I'll see you guys next time.